trying to cover all the past questions of Index 115 in the institute exams. This video is for you. Hello everyone, this is Bhavik Chokshi here and I hope you guys are doing great. In today's video, we would try to cover all the exam questions that have come from May 2019 when 115 came in for the first time all the way up to May 2022. So over here, the questions, there have been 8 attempts and approximately 9 questions. We discuss all of these so that you get a complete understanding of the coverage of 115. If you see the weightage on your screen, except for May 2019, where it has come for 5 marks, in almost every other attempt, India's 115 has come in double digits. So that is anywhere between, let us say, 10 to 14 marks. And hence, this is an important standard and questions have been fairly tricky as well. So let us try to cover all the questions in the best possible time. So let us get started. So over here, we start with the question coming in May 2019 for around 5 marks. This was on measurement of progress and recognition of revenue based on the stage of completion under the input method. So typically, if revenue is to be recognized over a time, then the revenue has to be recognized based on the progress done. And the progress can be measured using the output method or it can be measured using the input method. The input method over here can be calculated as the cost incurred till date upon the total estimated cost. While doing so, in case there are certain elements which are contributing substantially to the cost, and where the service provider or the entity is responsible merely for purchasing and installing it, the assets are of the customers and our responsibility is just kind of purchasing and installing it, no further obligation, then in such cases, the standard allows you to split the cost to cost input method, whereby it says that to the extent of these material costs where you don't have great modifications or changes to make, you will recognize revenue to the extent of cost incurred, whereas for other elements, you will measure progress based on the other cost incurred and the total estimated cost, and hence the revenue recognition will proceed accordingly. So applying that concept, we go to question number 1. Orange Limited contracts to renovate a 5-star hotel, including the installation of new elevators on 1st of October 2017. Orange estimates that the transaction price is 480 lakhs and the expected cost of the elevators is 144 lakhs and the other expected cost is around 240 lakhs. So basically, if you look at your total cost, that's 144 plus 240, that comes to 384. Orange purchases the elevators and are delivered to the site 6 months before they will be installed. Orange uses an input method based on cost to measure progress. Okay, so that is cost incurred upon total estimated cost, and the entity has incurred actual other cost of 48 lakhs during 31st March 18. How much revenue will be recognized as per 115 for the year ended 31st March 18 if performance obligations are discharged over time? First of all, we have to tell the examiner that why will we need to adjust the input method. So over here, we will say that there is a major input in the form of elevators, for which a major component of cost, so this is, let us say, cost incurred and total estimated cost. So over here, your cost incurred for elevator is 144, your total estimated cost is also 144. For the other cost, on the other hand, your total cost incurred, I think, is estimated is 240 crores, out of which 240 lakhs, out of which 48 lakhs of cost has been incurred. And as a result, if I want to really measure progress, my progress will be measured based on the stage of completion. So for the elevators, they have been purchased. The elevators cost 144 lakhs and they are purchased and delivered 6 months before they will be installed. So over here, the work on the spending on the elevator is done. The progress is, let us say, 100%, 144 by 144. But for the other projects, this is other cost. This is 48 by 240 and that will come to approximately 20%. And hence the revenue that should be recognized, your total revenue, which is attributable to elevators, will be equal to the cost incurred. So what is your total cost? It is 144 and hence the total revenue attributable to elevators will also be 144. On the other hand, when we look at the total revenue from the project, your total revenue is expected to be around 480 lakhs. and out of 480 lakhs, you can say 144 is attributable to elevators, and hence the remaining 336 is attributable to other items, and hence the revenue based on that which needs to be recognized as per the year 17-18 based on the stage of completion would be 144 of cost incurred, and against that the entire 144 will be recognized as revenue, and for the remaining amount you have 336. However, the stage of completion is only 20%, and hence 336 into 20% will come to approximately 67.2, and hence the total revenue that should be recognized will be 211.2 against a total cost that is incurred of around 192. Okay, so let us just quickly verify. You will explain the examiner why you are adjusting the input method, and you measure stage of completion at 20%, and your total 211.2 will be your total revenue to be recognized, 144 and 67.2. So that takes care of the 5-mark question in May 2019. Now the next question that had come in November 2019 was a very interesting question where a lot of students thought that the question is not properly drafted, though it kind of is. Just that over here you have to remember that the question is solved considering the output method, and there are a few things that you have to remember when you measure the output method. So when you typically recognize revenue under the input method, the revenue exactly matches the cost incurred. So if your total cost, for example, in the project is 100 crores and the estimated revenue is, let us say, 150 crores, and you incur 30% of the cost. So 100 ka 30%, that is 30 crores you incur, then you recognize only also 30% of revenue. So the cost matches with the revenue. However, when we look at an output method, it is not necessary that the cost incurred matches with the revenue being recognized. For example, if you are constructing a building and that building has 100 flats, when you dig up the foundation, when you are constructing the foundation of the building, you do incur certain cost. However, no part of the output is ready, and hence if an architect or a valuer comes and says, he will say that out of 100 flats, 0 flats are ready. However, let us say there are 16 flats which are ready, in which case the architect would say, well, out of the 100 flats, 16 are ready, and as a result 16% of the project or the output is ready. But the cost incurred is not just for those 16 flats, you have also dug up the foundation and everything, and as a result there would be a slightly higher cost, which is also possible. And as a result, over here, what happens in case you have incurred cost but sales are not yet recorded? Well, that typically happens in case of inventory, when you are manufacturing an inventory but you have not yet sold it, in which case you show this as work in progress. In a similar way, over here we show this as contract work in progress. And how do you calculate contract work in progress? It is calculated as your total cost incurred. For example, 30 crores is your total cost incurred minus the cost to be recognized against the goods sold. So over here, if your revenue is 16%, then against the goods sold, the total cost should also be 16% of the total cost. So we will say, okay, 150 into 16% will be the revenue. To match with that, 100, which is your cost, into 16% should also be the cost recorded. However, the cost that you have spent is actually 30 crores, but you have recorded only 16 against sales. But what about the remaining 14? Well, it is like inventory, closing stock, which will become opening stock in the next year and will be recorded against the revenue of the future years when the corresponding revenue gets recorded. So profit is calculated based on the revenue, which is based on the output method, minus the cost incurred, again, which is linked to the revenue that you are recognizing based on the stage of completion. Your contract work in progress or inventory is measured as a difference between the cost incurred minus the total cost, which is recorded against the sales. Lastly, the question might also ask you to show how much is the amount which is due from or to the debtors. Now, ideally, if you stick to our example, where you would have 150 worth of sales into 16%, let us say, is what the architect had certified based on the output method, in which case 150 into 16% will come to around, let us say, 24 rupees should be the revenue recognized, which will be recognized, and hence your billing or debtor should also be to the extent of 24. However, it is possible that you might have done a billing and collected money worth, let us say, 30, or you might have done a billing and collected money worth, let us say, 15. So over here, if you have collected and billed 30, that means you have received an advance. Ideally, you should receive only 24 based on the revenue that is recognized, but you have received 30, and hence that 6 rupees is an advance from the customer. On the other hand, if you have done billing worth only 15, whereas the revenue is 24, then 9 rupees is the amount which is due from the customer, like a receivable. So this is what question number 2, which had come in November 2019, which is a very special kind of a question, tries to address. So let us see if you are able to get that. Question number 2. There is Nivan commenced the work on 2 long-term contracts during the financial year 31st March 19. The first contract was with A&D company, which commenced on 1st June 18 and had a total sales value of 40 lakhs. So this was a total sales value. It was envisaged that the contract would run for 2 years and that the total expected cost would be 32 lakhs. So we are expecting a profit, let us say, of 8 lakhs to start with for the entire contract. On 31st March 19, that is by the end of the year, Nivan revised the estimate of the total expected cost to 34 lakhs on the basis of some additional rectification cost of 2 lakhs incurred in the contract during the current financial year. Now, unless it is given otherwise, we have not assumed that this is an abnormal loss. This is just a change in the contract cost. So this is 34 lakhs. An independent surveyor. Now, this line of the question makes it different from every other question that has come, which is usually using the input method. An independent surveyor has estimated at 31st March 19 that the contract is 30% complete. Okay, so your revenue should be based on the output method of the surveyor, which is 30% done. Nivan has incurred cost up to 31st March 19 of 16 lakhs and has received payments on account of 13 lakhs. Now, there will be another company, B&D company, with which you have done the contract, but we will do one of them. Second, to be honest, you can even pause the video and try on your own. The question at the end says, prepare financial statements extracts for Nivan in respect of the 2 construction contracts for the year ended 31st March 19. So over here, there is the output method. There is A&D company. What all will you try to see? You will try to see contract profits in the financial statements, profit and loss. So there will be contract profits. Then you will try to find the contract inventory or contract work in progress. And you will also try to find the advance / receivable. So these 3 items will appear in your financial statements. Now, how will you calculate these numbers? First of all, for A&D company, B&D company, and then total. So when we are looking at each of these cases, we will try to find the contract revenue. When we try to find the contract revenue, the total estimated revenue for A&D company is 40, and this 40 does not undergo any change. So when we do 40 into, let us say, 30%, you will get 40 into 30% will come to 12. So your revenue to be recognized will be 12. Against that, the cost that is to be recognized will be, let us say, your total estimated cost, which is now revised. You will take the latest estimate, and the latest estimate gives you a 34 estimate of cost. So 34 into 30% will be your total cost to be recognized based on the matching principle. So whatever revenue is recognized is 30% of the revenue. So the corresponding cost should also be 30%. Sir, but we have incurred more. We have incurred probably 16. Well, so be it. It is possible that you might manufacture 1 lakh units of inventory, but you sell only 80,000. In which case your cost incurred is for 1 lakh units. 80,000 is sold. COGS is against 80,000. The remaining 20,000 is shown as inventory. So over here you will have profits. And these profits are to be in the tune of, let us say, 1.8. Secondly, for A&D company, if you want to find the inventories, over here for inventories, you will try to find the cost incurred actually. And the question tells you that during the year, you have incurred a cost of 16, everything in lakhs, minus the cost which is attributable to the goods sold. So if you are trying to find the cost attribution to goods sold, we will say that out of the total cost, 10.2 is attributable to the goods sold, and hence the remaining 5.8 is cost incurred, but revenue still not booked, and hence this is like the contract work in progress, which will be shown, let us say, as an asset under inventory. Lastly, for A&D company, how much is your revenue that is recognized? We will say, well, the revenue recognized is 12. And hence, ideally, the billing should be to the extent, so progress receipts or progress billing / receipts should be to the extent of 12 only. However, we have billed and received, I think, 13 lakhs. And hence, for something which is worth 12, which is recorded, we have received 13. So 1 we have received extra. So this is like advance. So this will be advance from customer. So this is like a liability. So on an overly simplistic base, if I were to put journal entries of this, when I receive 13, my entry will be bank account debit 13, to sales 12, to advance 1. Against this 12 sales, if I have to recognize cost, I will pass the entry COGS on an overly simplistic basis, COGS account debit, let us say 10.2, contract work in progress account debit, let us say 5.8, to bank, let us say 16. So if you are able to solve this for A and company, well, B and company is a cakewalk. You will easily be able to solve it for B and company as well. So the second contract of B and company commenced on 1st September 18 and it was for 18 months. The total sales value was 30 lakhs and total expected cost is 24 lakhs. Okay, the payments on account received were 9.5 and the cost incurred was 8 lakhs. Diwan has insisted on a large deposit because the companies had not traded together prior to the contract. The independent surveyor estimated that the contract was 20% complete. Remember, if this line that I've highlighted is not given, you would have taken the cost incurred, which is 8 lakhs upon the total estimated cost. This is 24 lakhs and said that the project is, let's say, 1/3 complete. However, in this case, you have been specifically told that it is 20% complete and hence you will have to do the recognition based on that. In which case, your total estimated revenue under this second contract is expected to be around 30 lakhs. So 30 lakhs into 20% will be your revenue, which will be 6. You can pause the video actually and try for B and company once on your own. Otherwise, you can just continue. Against that, the corresponding cost will be 8 into again 20%. So 8 into 20% will come to, let us say, 1.6. No, sorry, 8 is the cost incurred. So this will be 24. There is no revision in cost. So 24 into 20% will come to 4.8. However, so your profit will be 1.2. However, your cost incurred against the contract of B and company is actually a cost of, let us say, 8, out of which 4.8 is attributable against the goods sold, and hence the remaining 3.2 is against goods which are not yet sold. So this is like inventory. For B and company, your total revenue that is recognized is 6 rupees. And against this, the billing that you have raised is 9.5. So you have collected 3.5 again in advance from the customer. And hence, if you look at the total in your financial statements, 18 worth of revenue, 15 worth of COGS and 3 worth of profit will be recorded. In terms of your inventory, a total inventory worth, I think 9 would be recorded, and a total advance which is worth 4.5 will be recorded in the form of liabilities. So these are the crucial numbers which we will try to verify and see. The other part of the question just mentions that the contract is as per Ind AS 115 and assuming there are no other contracts or there are several other contracts, but we have to just focus on these two. What will be the effect? So if you go to see, your final number should ideally tally 3 of profit, 18 and 15 of revenue and cost of goods sold. 4.5 is the amount due to the customer, that is the advance received from the customer, and work in progress as a part of the asset is around 9, and this will be appearing in the financial statements. Next, you have another question number 3, which is from the November 20 exams. Remember, May 20 did not happen due to COVID, so this is the November 20 exam question. An interesting question and a slightly more complex question with various alternative treatments. This is question number 3. Similar questions have also come, I think, as recent as May 22. However, they are on a slightly more easier method, whereas this is slightly more complex. So let us read question number 3 once. In this case, what is happening is, before we read, just to get a conceptual framework, there is a quantity linked discount. However, the quantity will come to our knowledge later. And as a result, if we have to recognize sales, we need to determine the transaction price based on our expectations. And if there are variable considerations, then variable consideration can be measured either using the expected value method or using the most likely value method. So over here, let us read question number 3. ABC Limited supplies plastic buckets to wholesale customers. As per contract entered between ABC and a customer for the year 1920, the price per plastic bucket will decrease retrospectively as sales volume increases within the stipulated time of 1 year. Okay. the price applicable for entire sale will be based on the sales volume bracket during the year, which can be 90, 80, 70, depending on the sales volume of up to 10,000, up to 35,000 or above 35,000. All transactions are in cash. Suggest how revenue is to be recognized in the books of accounts of ABC as per the expected value method, okay, which is the probability based weighted average method, considering a probability of 15%, 75% and 10% for sales volume of 9,000, 28,000, 36,000 respectively. For workings, assume that ABC achieved the same number of units of sales to the customer during the year as initially estimated under the expected value method for the year 1920. Now, when you look at this particular case, there would be the second case as well, and in the second case everything remains the same, just that you are expected to do things using the most likely method instead of the expected value method. In the third case, you are just asked to pass the journal entry. So the first case, in my opinion, there are two alternative treatments which are possible, which will result in the same ultimate effect. However, when you are solving it, you can solve using either one of the two. Institute has solved using one of them. It is not that it is wrong, but it is not the only option possible. So when we look at question number 3, subpoint 1 says we need to solve this using what is called as the expected value method, which means you have to look at all the outcomes and their probabilities. So the number of units are either 9,000, which you expect a 15% chance, 28,000 a 75% chance, and lastly around 36,000, which is a 10% chance. Now you can try to find the probability based weighted average and find the number of units, but you need to remember that the revenue at each of these levels are different. So if actually you attain a sales of 9 per unit, the transaction price per unit would be rupees 90. If you actually attain 28,000, your transaction price would be 80, and at 36 it will be 70. As you can see, these are at different buckets. The first one is within the 10,000 bucket, second is within the 35,000 bucket, and the third one is above 35,000, and hence there will be different transaction prices. And hence if you want to find a revenue at each of these levels, you will have to multiply the two. So I guess this is 8,10,000, 28,000 into 80, this is I think 22,40,000, and 36,000 into 70, this is I think 25,20,000. Okay, so these are your revenues, and against that, if I want to find the expected output and expected revenue, I will have to consider the probabilities, which in this question is 0.15, 0.75 and 0.10. So if I want to find the expected units, I will have to multiply the units with the probability. So 90,000 or 9,000 into 0.15 m plus, this is 1350, 28,000 into 0.75 m plus, this is 21,000, and 36,000 into 0.1 m plus, this is 3,600, and hence on an average the units that I am expecting is 25,950. This is my expected units. As per ICAI, also this is 25,950, which is perfect. ICAI also calculates what is called as expected revenue, which means it says that, well, if the units are 9,000, the revenue is 8,10,000, and at 8,10,000, the chance of 8,10,000 is happening is 0.15. So this is 121,500. The chance of 22,40,000 happening is 0.75. So this is 16,80,000, and the chance of 25,20,000 happening is 10%, and hence this is 2,52,000. So if I total all of this, I should get 20,53,500. So this is my expected revenue, and hence if I want to find my expected transaction price per unit, considering the expected revenue of 20,53,500 and 25,950 as the expected units, I will divide the two, and I should get around 79.13, and hence the revenue should ideally be recorded at 79.13 per unit, whichever units, whenever they are sold. Now this is the method that the institute has used. I'm not saying that this is the only method and the right method. There is an alternative method where one can always say that, well, let us take the expected units at 25,950, in which case if the 25,950 is attained, which is in the second bucket, my transaction price will be 80, and hence revenue recognition can be based on that 80 as well. So revenue over here might slightly differ. However, if I follow the institute's method, which is not wrong, but I'll again repeat, it is not the only method. There can be another method possible. So over here, if I were to recognize revenue, I would say revenue will be recognized at the rate of 79.13 per unit. This is under the expected value method. If I want to follow the most likely value method, the second part of the question says all else remaining constant, what will happen if I follow the most likely method? So the first part asks you that suggest how the revenue is to be recognized. You will say 79.13 for every unit sold. Second part says, in case ABC decides to measure revenue on most likely method instead of expected value method, how would the revenue be recognized in the books of ABC based on the above information? For workings, assume ABC achieved the same number of units as initially estimated under the most likely value method. Now, among the three values available, the value at 28,000 seems to be the most likely, and hence because it has a 75%, so your most likely units sold would be 28,000 units sold, and this has a 75% chance. If you understand how the most likely value method functions, you will take the probability for selecting the most likely value, and once you find the most likely value, you don't again multiply it by the probability, so you don't have to multiply this again by 0.75. And if this is the most likely units and this is your estimate, then your most likely transaction price per unit should be rupees 80 directly. There is no 79.13 over here, and your most likely sales would be 28,000, and for every unit that is being sold, rupees 80 will be your sales. So this is 28,000 into 80, and this will be 22,40,000, and that's it. Over here, this is 22,40,000. Now, subpoint 3 of the question says, you are required to pass journal entry in the books of ABC if the revenue is accounted for as per the expected value method for the financial year 1920. Expected value is the first subpart. So, if you go by the institute's working in the first subpart, for the first 10,000 units that were sold, the customer will pay us 90 per unit. Remember, the threshold is crossed at 10,000, so till that time they will pay us 90 per unit, and hence 9,000 into 90. No, sorry, not 9,000, 10,000. For the first 10,000 units, it will be rupees 90. So over here into 90. So will be bank account debit. Let us say this will be 9 lakhs. However, against this, the sales that you are going to record will be 10,000 into, we have said for every unit sold, we will record 79.13, and hence 7,91,300 would be the sales, and hence for the remaining you will show either an advance, deferred revenue, unearned revenue, or simply stated a contract liability, basically a liability under a contract. You don't have an obligation to refund. However, you would have probably issued a credit note, and hence 9 lakhs minus 791,300 will come to 1,08,700. Now for the remaining 15,950 units, how much money would you receive? Now one could say that I will receive 15,950, and at this time 80 per unit, because now the volume discount is applied. However, for the first 10,000 units, I have paid 10 rupees extra. Sir, how 10 rupees? Instead of paying 90, I have paid instead of paying 80, I paid 90, and hence I would have a credit note for 10 rupees, and hence during this time frame I will pay 1 lakh rupees less, because in the past I paid 1 lakh rupees more. So this is 15,950 into, let us say 80, that's 1276, minus 1 lakh comes to 11,76. So this is bank account debit 11,76. To, we'll leave a couple of lines. To sales, you will still say that the revenue that is to be recognized is 15,950, and for every unit sold 79.13. So your revenue will be 15,950 into 79.13, sorry, 15,950 into 79.13. This comes to 12 lakh 62,000, let's say 24. So what about the remaining? What about the balance? Well, the balance is to be adjusted against the contract liability. Ideally, I should have received 12 lakhs and something. I'm receiving only 11 lakhs and 76 because in the past I've paid more, and that is sitting inside the contract liability. Well, you will adjust the contract liability to the extent of the balancing figure. So over here, this is 1262,124 minus 1176, and hence this comes to around 86,124. But your contract liability is actually 1,08,700. So there would be certain balance in the contract liability, and this balance is a credit balance of 1,08,700 minus 86,124, which equals 22,576. Will this contract liability continue? No, because the contract is over, 1 year is over. Then what will you do with the contract liability? Well, you will transfer it to revenue, like you even do for customer loyalty points. You will transfer this to revenue. So your journal entry would be contract liability account debit, let us say 22,576 to revenue. Now, a lot of times students wonder that why should this go to revenue? Well, the logic over here is ideally you should have booked a revenue of 80 rupees. For every unit that is getting sold, you should have booked a revenue of 80 rupees, but you ended up booking a revenue of 79.13. That is, you short booked a revenue of 87 paise for 25,950 units, and hence if you multiply this by 25,950, you are going to get the exact same answer of 22,576. This is your revenue short booked. Ideally, your total revenue should be 20,53,500. However, if you total both of these, 791,300 and 1262,124, you will not get 20,53,000 because you have short booked revenue. You have booked it at only 79.13, whereas you should have ideally booked it at 80, and hence for this remaining 0.87, you will recognize the revenue at the end of the contract tenure. This is a slightly complex answer. Having said that, in my opinion, an alternative solution is possible over here, when one can argue that, well, if 25,950 units are actually expected to be sold, then we can take 80 rupees, which is the selling price for the 25,950. In which case, your journal entry will be, well, your bank account will still be 9 lakhs because for the first 10,000 units, you're still going to get 9 lakhs. But over here, you will have two sales, 10,000 into 80, so this will be, let us say, 8 lakhs, and contract liability will be the remaining 1 lakh. Next, when the remaining 15,950 are sold, I should ideally get 80, and there was a 1 lakh rupee credit even over here, and hence this will still be 11,76,000. But when I book the sales over here, this will be 15,950 into 80, and hence this comes to around 12,76,000, and hence exactly that 1 lakh will be reversed in case of the alternative solution. So you don't have to adjust anything else in the contract liability because it has already been exhausted. In the institute's version, you need to adjust because you have recorded revenue only at 79.13, whereas the revenue should ideally be at 80. Here you have recorded at 80, and hence there is no further liability remaining. This is under the expected value. The institute does not ask you to pass using the most likely value, but if you do using the most likely value, it is very easy because in the first 10,000 units, you will record sales at 80. The remaining 18,000 units, because here the most likely sales value is 28,000, the remaining 18,000 units also at 80, you will create a contract liability in the first 10,000, which will get reversed in the next 18,000. So that takes care of question number 3, a slightly interesting question from November 2020 exams. The next, so there are, we have taken the institute's suggested solution. Then is question number 4 from November 20 as well, but a slightly more simpler question. Entity A negotiates with major airlines. So this is on principal and agent. Remember, between principal and agent, how do you recognize revenue? If I'm a principal, I will recognize the revenue on a gross basis. If I'm an agent, I will recognize the revenue on a net basis. How do I determine that I'm a principal or an agent? Well, if I'm primarily responsible for performing the performance obligation, I bear to some degree the inventory risk. I also have discretion in pricing. So all of these are indicators. It's not an exhaustive list. The most primary thing you need to check is who is responsible for discharging the performance obligation. So an entity negotiates with major airlines to purchase tickets at reduced rates as compared to the price of tickets sold directly by the airlines to the public. So let's say like a big travel agent like Cox and Kings might purchase a block of tickets from British Airways. It is purchasing in its own name. The entity agrees to buy a specific number of tickets and will pay for those tickets even if it is not able to resell them. So over here the inventory risk of the tickets is with Cox and Kings. The reduced rate paid by the entity for each ticket is negotiated and agreed in advance. Okay, so probably they've agreed to sell these tickets at 40,000. The entity determines the prices at which the tickets will be sold to the customers. Maybe the entity thinks that we'll sell this at around 50,000. The entity sells the tickets and collects consideration of the customers when the tickets are sold. Therefore, there's no credit risk. So it's cash sales. But even if it is credit sales, it will still not alter the solution. The entity also assists the customer in resolving complaints with the services provided by the airlines. However, each airline is responsible for fulfilling obligations associated with the ticket. Remember, the entity's obligation is to sell the ticket. So entity has to sell the ticket. Now, on that ticket, you have to go to London. That is a responsibility of the airline. But the entity's principal responsibility is to sell the ticket, which it is selling as a principal. It is tickets purchased by the entity itself, which it is selling to the customer. It is bearing some inventory risk, has discretion in setting up pricing as well. Whether the entity is a principal or an agent with suitable explanation, we would generally suggest in this case that the entity acts as a principal because it is primarily responsible for discharging the obligation of delivering the ticket. Also carries to a certain degree the inventory risk if the tickets remain unsold, and it also has the pricing discretion of setting up prices in a manner it likes. So it acts as a principal on those tickets, should ideally recognize the gross revenue. If it is selling a ticket at 50,000, it will recognize 50,000 as revenue, and if it has purchased it at 40,000, that will be like the cost of goods sold, and as a result, you will not just recognize the net 10,000 as commission, but you will recognize 50 and 40. So that is regarding question number 4, a fairly easy question. Then comes the Jan 21 exam question for revenue. Again, this is a fairly interesting question. So there was another attempt because of the attempt skipped and an option given by the institute in November 20. Jan 21 there was another attempt. So this is a question. I would rate this as important as well. Now over here there are various things to be seen. There can be a significant financing component, there can be services, there can be machines, various things to be reviewed in this question. A Limited is a company which is in the business of manufacturing engineering machines and providing after-sales services. The company entered into a contract with Mr. Anik to supply and install a machine, namely model PI, on 1st April 18. And to service this machine on 30th September 18 and 1st April 19. The cost of manufacturing the machine to A was 1,60,000. Okay. It is possible for the customer to purchase both the machine, that is PI, and maintenance services separately. So how many maintenance services have we agreed? So there is the company entered into contact with Mr. Anik to supply and install a machine. So that is one promise. I will supply and install a machine for you and service the machine on 30th September 18, that is after 6 months, and 1st April 19, that is after 12 months. And hence I am under 3 responsibilities. I will have to supply the machine. I will have to do the first service on 30th September, the second service on 1st April 19. It is possible for a customer to purchase the machine and perform maintenance services separately, but Mr. Anik has purchased both. Mr. Anik is contractually obliged to pay A Limited 4 lakh rupees. So this is the transaction price. We can first try to identify the performance obligations over here, where we can say delivering model PI is the first performance obligation, which is getting discharged on 1st April 2018. The first service that you are rendering seems to be another performance obligation, which is getting discharged on 30th September 18. And the second service that is also to be rendered seems to be another performance obligation, which is getting discharged on 1st of April 19. For all of these 3, Mr. Anik is agreeing to pay a total transaction price of 4 lakh rupees. But this is agreed to be paid on 1st of April 19, which is 12 or more months away from the date model PI is sold, and hence there is a possibility of a significant financing arrangement being in existence. So over here, when the time gap is 12 or more than 12 months, the transaction has a significant financing component, and hence the adjustment for interest should be done. Now there is obviously a slight controversy over here where one can say that the gap between the date when model PI was delivered and 4 lakhs is paid is 12 months, and hence there will be a significant financing component. The gap between the second service, which is rendered on 1st April 19, and the date when the payment is made, that is 1st April 19, there is no gap, and hence there will be no interest adjustment. But the controversial adjustment over here is the service being rendered on 30th September 18 to the payment happening on 1st April 19. The gap is only 6 months. So should you do a time value adjustment over here? Remember, not just in this sum, across your syllabus, whereas a part of a single arrangement, you are making payments at various points of time. You either do time value adjustment on all the payments or you do it on none of them. You will not do on part of them and not do on the remaining part of them in general. So, for example, when we even studied Ind AS 16 on property, plant and equipment, if I were to buy a machine today and make a payment after 2 years, then I do a time value adjustment considering the deferred payment guidance. However, it is possible that I might make a payment in 6 months, then another payment in 12 months, another payment in 18 months, and another payment in 24 months in 4 half-yearly installments. So, one can always argue and say that the installment that I am paying in 6 months does not have a time value adjustment, but the installment paid after 18th or 24th month will have a time value adjustment. So, the general rule is you either do a time value adjustment on the entire arrangement, that is including the 6 months and the 18 months, or do it on none of them. In this case, that is why the institute has done the time value adjustment on all, including the payment which is done even on 30th September, though one can always have an alternative interpretation for this. Having said that, the treatment done by the institute is consistent with what it does in even other parts of the syllabus. But an alternative interpretation and treatment is very much possible. So this is your transaction price. Now, going further, what does the question tell further? So over here, Mr. Anik is contractually obliged to pay 4 lakhs on 1st April 19. Fair enough. The prevailing rate for 1 year credit granted to the trade customer in the industry is 5% per a 6-month period. So this is not 5% per annum. For every 6 months, in the normal credit practice, a 5% rate is charged. As per the experience, the servicing of the machine model PI sold to Mr. Anik is expected to cost 30,000 to perform the first service. This is a cost. And 50,000 to perform the second service. Again, this is a cost. Assume actual cost equal expected cost. When A provides machine services to the customer in a separate transaction, it earns a margin of 50% on cost. This is for services. And on 1st April 18, the cash selling price of the model PI sold to Mr. Anik is 251,927. So this is what is giving you certain data about SSP or the standalone selling price. 251,927 is the standalone price, the observable price of model PI. Whereas when we are looking at the first service over here costs you I think 30,000. And to other customers on a standalone basis, I would have charged a 50% margin. The second service is 50,000. To other customers on a standalone basis, I would charge the 50% margin, and hence this becomes 45,000. This becomes 75,000. And hence if I on my calculators try to take the total, this comes to 251,927. 251,927 plus 45 plus 75, it comes to around 3,71,927. It does not really total up. Probably the difference might be attributable to a financing arrangement because a payment is made over here at or beyond 12 months and there is no other exceptions getting covered. So it might be attributable to, let us say, a financing arrangement. So how do we verify that? Well, let us try to prepare an amortization table and see if that is the case. So if I look at half years, let us say if I look at half years, for the first half year, the opening balance, if I were to pass the journal entries, my journal entries would be the moment I deliver model PI, Anik does not pay me anything, and hence if I were to pass the journal entries, my journal entries would be Anik account debit, let us say, to sales. Let us assume this is at the standalone selling price for the time being, in which case this is 251,927. Obviously, the moment I recognize sales, I will also recognize the corresponding cost of goods sold. which is, I mean, you are having an inventory. If you are following, let us say, the perpetual system of inventory, you will recognize it. If you are following the periodic system, well, in that case, it will automatically get adjusted in the opening and the closing stock valuation. But for simplicity, let us say a corresponding cost will also be booked, let us say to the extent of 1,60,000. But if I were to prepare the ANIC account, I am saying ANIC has to pay me 4 lakh rupees. It starts with 2,51,927 on 1st April 2018. Is ANIC paying you that today? No. And as a result, there would be some interest levied, and the question tells you that is at 5% flat for a 6-month period. So 251,927 into 5% will come to around 12,596. So ANIC should ideally pay you 251,927 plus 12,596. Is ANIC paying you? No. However, there is some additional service revenue which has to be further recovered from ANIC, but ANIC is not paying you that. So over here, if I go over the 6-month period, this is 1st April 2018. If I go on 30th September 2018, first of all, I can book a receivable from ANIC on account of interest. 6 months have passed, which is called as finance income. So over here, I can say that around 12,596 is recoverable from ANIC on account of the finance income. ANIC does not pay me that, but he takes further service from me. I incur certain cost and he takes further service from me. ANIC account debit to, let us say, service revenue. So your service revenue over here would probably be around 45,000 against incurring a cost of, let us say, 30,000. So on 30th September, your entry will be, let's say, service cost. You are spending around 30,000. So service cost, account debit 30,000 to, let us say, bank, let us say 30,000. Okay. So your further service revenue will increase by 45,000. Receivable from ANIC will increase. Is ANIC paying anything? Less paid, nothing. And hence your closing balance on 30th September 2018, let us say, from ANIC would be 251,927 plus 12,596 plus 45,000, all the three, that is 3,09,523. See, on 45,000 we have not yet charged interest because the performance obligation itself was discharged on 30th September. But ideally the money should be received on 30th September. It was not received, and hence going forward for the second half year, you will start at 3,09,523 on 1st October 2018. Charge interest on this at the rate of 5%, which is around 15,476. Service revenue will not yet be recognized because service is not rendered on 31st March 19. It is rendered on 1st April 19, that is in the next year. And nothing is paid, in which case your closing will be 3,09,523 plus 9,523 plus 15,476. So this will be approximately 3,25,000 rounded off a rupee. So this is around 3,25,000 approximately. Let us say I make this as 577, in which case Mr. ANIC has to pay me 3,25,000 on 31st March 19. Does he pay me? No. So over here, if I go to 31st March 2019, there will be a further interest receivable from Mr. ANIC of 15,277 to, let us say, finance income. I'm just doing this in short, of 15,277. Now come 1st April 19, ANIC takes further service from you. So ANIC account debit 75,000 worth of service to, let us say, service revenue of another 75,000, service revenue of 75,000, for which you are incurring servicing cost. So this is service cost, account debit 50,000 to bank, let us say 50,000. So you are matching the revenue against the cost which is incurred. Achha, so I book another 75,000, let us say, for the third half year. I started at 3,25,000. On 1st April 19, I book another service revenue of 75,000 also on 1st April 19, and ANIC also pays the entire 4 lakhs on 1st April 19. and as a result there is no further interest income to be recorded. Your Anik balance becomes nil, and as a result, if you go to see, Anik is paying you total of 4 lakhs. It is paying you within 4, he is paying you 4 lakhs ke andar 2,51,000 for the products, 45 and 75 for the service, and if I total up 12,596 plus 15,477, that is around 28,073 for a time, and that is your total consideration. So if I now look at the 1st April 2019 entry, my entry would be bank account debit 4 lakhs to Anik. So your Anik account closes. This is how the institute has solved, and hopefully you do understand what has been done. So if we go to see your total transaction price, one can say attributable to financing, we can say based on the calculations that we have done, 12,596 plus 15,477. Let me just total up. I think 12,596 plus 15,477 is 28,073 is attributable to interest or financing, which will be recorded from 1st April 2018 all the way up to 31st March 2019. Interest is recorded over time. So if I total up all of these, plus 45 plus 75 plus 251,927, I get exactly 4 lakhs, and that is the allocation of my transaction price. I don't need to do any separate allocation. That does not appear to be any further discount or any other variable consideration. Okay, the promised supply of model PI and maintenance services are satisfactorily carried out in time by the company. Okay, segregate the components of the transaction that A shall apply to the revenue recognition criteria as per 115. So the components over here would be model PI, first service, second service, and also financing. Second, calculate the amount of revenue which A must allocate to each component of transaction. So for model PI, 251,927, for first service 45, for the second service 75, and for the financing 28,073. Prepare the journal entries to record the information set out above in the books of A Limited for the year ended 31st March 19, which we have done, and 31st March 20 also. There is only the entry on 1st April 19, which we have done. And lastly, draft an extract showing how the revenue would be presented and disclosed in the financial statements of A for 31st March 19 as well as 31st March 20. So if I look at the revenue for the year 1920 and the revenue for the year I think 1819. So over here this is sales of products, that is model PI. The entire 251,927 will be recorded in 1819 because the sale happened on 1st April 18. The first service or the service revenue rather, if I look at servicing revenue, only 45,000 of the servicing revenue will be recognized in the year 1819, but the remaining 75,000 will be recorded in the year 1920 because the service is rendered on 1st April 19. And the finance income or the finance revenue of the entire 28,073 will be recorded in the year 1819 because on the first day of the next year, the entire amount is paid. So if I total up, 75,000 of the revenue will be recorded in the year 1920 and total of 3,25,000 including interest income would be recorded in the year 1819. Okay, so this takes care of question number, I think 5. This should be, I think, question number 5. That's right. A fairly important as well as interesting question. Acha, next you go to question number 6. Now this is a question which is very, very similar to the question which is there in your study material as well. For revenue, like the question about Anik and Nivan, were slightly different and they were slightly tricky. This is a question which you would have probably done. GTM Limited has provided 4 independent scenarios. You are required to respond to the queries mentioned at the end of each scenario. Support your answer with relevant extracts of the applicable index. So you have to mention the relevant theory as well. Scenario 1, GTM enters into a contract with the customer to sell G, T and M. So 3 products in exchange for 1,90,000. So this is your transaction price. These are 3 performance obligations. GTM will satisfy the performance obligations for each of the product at different points of time. And GTM regularly sells products G separately and therefore the standalone selling price is directly observable. So G has a observable price. the standalone selling price of T and M are not directly observable. Okay, but you can use other methods to derive them. Because the standalone price of T and M are not observable, company has to estimate them. To estimate standalone prices, it uses the adjusted market assessment approach. So it may use the prices of competitors and make certain adjustments. For product T, an expected cost plus margin approach. So the cost plus whatever is my margin, like you did in the earning question. For product M, in making these estimates, the company maximizes the use of observable inputs. That's fine. The entity estimated the standalone selling price as follows. So you have been given standalone selling prices and the total of the standalone selling prices is 2 lakhs. However, the transaction price that we have done is actually 1 lakh 90, and hence there is a 10,000 discount. So your discount, which is attributable, in this case, if you go to see in question number 6, if I want to look at the discount attributable to the bundle of G, T and M is actually 2 lakhs, which is the total of the standalone selling prices minus 1 lakh 90, which is the transaction price, that is 10,000. For discount, we need to check if the discount is first attributable to a smaller bundle, and if yes, you will first allocate it to the smaller bundle. So determine the transaction price allocated to each product. Here, there does not seem to be a smaller bundle, and hence you will allocate the discount directly in the ratio, or you will allocate the transaction price directly in the ratio of the standalone selling price. You can also allocate the 10,000 discount, reduce that allocated discount and find the transaction price, or you can directly do the workings. That is, you can say 1 lakh 90 into, let us say, 90 upon 200, which is allocated to G, 1 lakh 90 into, let us say, 44 upon 200 allocated to T, and 1 lakh 90 into 60, 6 upon 200 allocated to M. So this is 1 lakh 90 into 90 upon 200 comes to, I think, 85,500. 1 lakh 90 into 44 divided by 200 comes to 41,800. 1 lakh 90 into 66 upon 200 comes to 62,700. And if I total all of these, ideally I should be getting 1 lakh 90,000. Let me just verify this once. 85,500, 41,800 and 62,700. Perfect. In scenario 2, GTM regularly sells products GT and M individually. The standalone selling prices are as follows. I think you have the same standalone selling prices. In addition, the company regularly sells products T and M together for 1 lakh. Acha, T and M together. So ideally, the total of the standalone selling prices will be 1 lakh 10,000. However, you are selling them together. So this is, let's say, scenario 2. The discount which is attributable to only T and M is 1 lakh 10,000. The total of standalone selling prices, that is 44 plus 66 minus 1 lakh, and hence this is 10,000. So we can say substantially all of the discount is attributable to T and M only, and as a result we can allocate the discount purely to T and M, or we can directly do the transaction price calculation as well. So if I am doing the workings for T and M, I will say that, well, out of the total discount of 10,000, it is attributable to T in 44 by 110 ratio, attributable to M, so this is discount allocation, in 66 by 110 ratio, and as a result this is 10,000 into 44 upon 110 comes to 4,000 allocation of discount and 6,000 allocation of discount to M. Therefore, when you look at the transaction price, your transaction price will comprise of G. There is no discount allocation which is coming to G. There is no further discount remaining as well. T, you start at 44,000. However, 4,000 of discount is calculated above is allocable to T, and you start at 66 over here, and the 6,000 of discount is allocable to M, and hence your transaction price, this is like your standalone selling price, your transaction price will still be 90. That is what I reasonably expect, 40 and 60, and hence that will total up to a total of 1 lakh 90, the allocated transaction price. Okay, the company enters into contact with another customer to sell GTM in exchange for 1 lakh 90. GTM will satisfy performance obligations for each of the products at different points of time, or T&M at the same point of time. Determine the allocation of transaction price to T and M. We just have to do it for T and M. We have done it for all the three. It will be 40 towards T, 60 towards M. If they are discharged at different points of time, you will record the revenue of 40 when T is discharged, revenue of 60 when M is discharged. If they have recognized together, then academically you will recognize 60 towards T and 60 towards M and 40 towards T at the same point of time. Or from a practical simplicity, you would say that if they're sold at the same point of time, then ultimately 1 lakh of sale has to be recorded, which you will record it as 40 plus 60 or 1 lakh together at the same point of time. But this is the most accurate answer for scenario 2. Scenario 3, GTM enters into a contract with a customer to sell GTM as described in scenario 2, that is at 1,90,000 base. The contract also includes a promise to transfer product Hope, and the total consideration in the contract is 2,40,000. Achha. So there's another performance obligation, that is Hope. The standalone selling price of the product Hope is highly variable because the company sells product Hope to different customers for a broad range, that is 40,000 to 65,000, and hence you cannot find an observable price. Determine the selling prices of G, T, M and Hope using the residual approach. So remember, when you are applying the residual approach, you can apply the residual approach only after you allocate the discount. So let us say, I've just kind of written it at the wrong place, but nevertheless, let us say if I allocate the discount, question number 6 continued, then G will be worth 90 after discount allocation, T will be worth 40 after discount allocation, and M will be worth 60 after the discount allocation, which means whatever is the remaining is attributable to Hope. So your transaction price now is 2,40,000 and hence the remaining 50,000 is attributable to Hope. Now you can't just accept 50,000 under the residual approach, because residual approach is like not really a valuation method, but it is a balancing figure approach. It just says that your balancing figure is your answer, and hence in order to verify, we will have to compare this 50,000 with the price which the entity reasonably expects, which is between 40 and 60. Since 50,000 is between 40 and 60, it can be accepted as the allocated transaction price. Now when you look at scenario 4, the facts are same as scenario 3, except that the transaction price is 2,25,000 instead of 2,40,000. Discuss how the price should be allocated. This was scenario 3. If you look at scenario 4 as well, we don't have a separate method given in the question, and hence these three will continue to be at the allocations. However, the transaction price is 2,25,000, out of which 1,90,000 is allocated to GTNM, and hence the remaining, I guess 35,000 is allocated to Hope. Now 35,000 is not a price that an entity reasonably expects to receive for product Hope, and as a result you may require to take an alternative method like a cost plus method, like an adjusted market method, find the value for Hope and then do an allocation further. You will not be accepting 35,000 because it is not the price that an entity reasonably expects to receive. So this theory needs to be explained. So if you go to see, there's 40 and 60 over here. In scenario 3, 50,000 is going towards Hope, and in the last one you are saying consequently the entity reviews observable data to estimate the standalone selling price of Hope using another alternative method, because 35,000 is not what an entity reasonably expects to receive here. Okay, so that takes care of the question in July papers. Now you go to the December 21 papers. Let us read this. An entity has a fixed fee contract for 22 lakhs to develop a product that meets specified performance criteria. The estimated cost to complete the contract is around 20 lakhs. Okay. The entity will transfer the control of the product over 5 years, and the entity uses the cost to cost input method to measure the progress on the contract. Okay, so over here there's a contract which has a fixed fee of around 22 lakhs and the estimated cost to complete the contract is 20 lakhs. So there seems to be a 2 lakh profit. The entity will transfer control over a period of time, so that is over the 5-year period, and it uses the input method to measure the progress. That is fine. So you will have to take the cost incurred upon the total estimated cost. An incentive award is available. So this seems to be variable consideration. If the product meets the following weight criteria, that is, if it is greater than 951, very heavy, like a missile is very heavy, I want a lighter missile, then you will get 0 incentive. If it is between 700 to 950 kgs, you will get 2,20,000 as incentive. above 700, then you're going to get 5,50,000 as incentive. The entity has extensive experience creating products that meet specified performance criteria. Based on its experience, so it has experience, so there does not seem to be a constraint for variable consideration. Based on its experience, the entity has identified 5 engineering alternatives that will achieve the 10% incentive and 2 that will achieve the 25% incentive. So I've made blueprints and I've seen that there are 5 designs by which I can get the weight between 700 to 950, and there are 2 designs which can give me a weight of less than 25%. Now we can ask the company that what is the chance that you believe that the weight will be between 700 to 950. These are different designs, remember. In case the entity determines that it is 90% confident that will achieve the 10% incentive and 10% confident that will achieve the 25% incentive. काफी स्टूडेंट्स यहाँ पे क्या करते हैं, they try to total up the probabilities. They say 90 and 25. You don't have to total up. There are 2 different questions. Question number 1, that will you achieve the 10% threshold using those 5 designs? 90% yes, 10% maybe not. Even those designs might fail. Second question, a separate question, that will you achieve the weight of less than 700 using the 2 designs that you have made? 25% yes, 75% no. There are 2 different questions. Based on this analysis, the entity believes that it is 10% to be the most likely. Question clearly tells you the most likely amount when estimating the transaction price. So we have to follow the most likely method, and 10% over here is 10% of 2 lakhs, that comes to 2,20,000. So that is variable consideration which you should include if it is not constrained. So in the first 3 years that would be taken as the base when estimating the transaction price. Therefore, the entity includes only the 10% award in the transaction price when calculating revenue, because the entity has concluded that it is probable that a significant reversal of the cumulative revenue recognized will not occur. So if I record 2,20,000 along with my transaction price, it is not likely that a revenue for that 2,20,000 will have to be reversed. When the uncertainty associated with the variable consideration is subsequently resolved due to the 90% confidence in achieving the 10% award. So we will take most likely value, that is not 2,20,000 to 90%, we will directly take the 2,20,000. If it was expected value, yes, you take the probability based weighted average. So your transaction price will be 22 lakhs plus another 2,20,000 at least in the years till the time there is a change. The next question is, can your transaction price change? Your answer is yes. Well, why not? The entity reassesses its production status quarterly in order to determine whether it is on track to meet the criteria for the incentive award. At the end of year 4, so this is during year 4, it becomes apparent that the contract will fully achieve the weight-based criteria. Therefore, the entity revises the estimate of the variable consideration to include 25% incentive fee in year 4, because at this point it is probable that a significant reversal in the amount of revenue recognized will not occur when including the entire variable consideration in the transaction price. Okay. Analyze the impact of changes in variable consideration when cost incurred is as follows. So you are supposed to analyze the impact of these changes where variable consideration over here changes. Now from year 4 we believe that you will touch the 25% weight criteria, in which case you will get 2,50,000. This changes in year 4, which means in the first, second and third year you continue to believe that you will receive 2,20,000. Going forward you will now believe that you will receive 5,50,000, but this happens in year 4. So you have been given the cost incurred. Remember, you have been told that the stage of completion is calculated using the cost to cost input method, and which is typically you try to find the stage of completion as the cost incurred upon the total estimated cost. So you have been given 5 costs, and if you total up these 5 costs, this is 1,20,000, 3,70,000, 8,20,000, 5,70,000, 1,20,000, and hence this comes to 20 lakhs. This is the cost that you were originally expecting. Remember, the cost can also change. Acha. Calculate the yearly revenue, operating profit and margin in percentage. For simplification purposes, calculate the revenue for the year independently based on the cost incurred during the year divided by the total expected cost, with the assumption that the total expected cost do not change. Okay, so over here we are going to calculate the revenue based on the stage of completion in each of the years. So basically the last paragraph over here that you read allows you to simplify the solution and can work in questions where you have been allowed to do for simplification the revenue for the year based on the cost incurred during that year. Ideally, if you have done even AS7, your stage of completion is calculated based on the cost incurred till date upon the total estimated cost and not just cost for a particular year. So the institute solution over here for a simplification purpose is done considering the cost of each year. From a foolproof solution perspective, you can ideally try to do it based on the cost incurred upon the total estimated cost as well. Or in this case, if you have been allowed to do it, you can take the cost incurred of a particular year like 3,70,000 upon the total estimated cost of 20 lakhs and recognize revenue directly based on that number. So your answers will not differ. So whether you do it using the method of till date minus earlier recorded, or in this case for simplification based on the current year itself, your answers ultimately will not differ. So if I were to do the solution from a slightly longer method, what is the cumulative cost incurred? The cumulative cost incurred in the first year is 1,20,000. In the second year is 1,20,000 plus 3,70,000. I guess this is 4,90,000. In the third year, to this you add 8,20,000 and hence this is 13,10,000. In the fourth year, you add 5,70,000, which comes to 18,80,000, and then in the last year you add 1,20,000 and hence this comes to 20 lakhs. Based on this, you calculate stage of completion, that is the cost incurred till date, that is 1,20,000 divided by the total estimated cost, that is 20 lakhs, and then 6% is your stage of completion, then 4,90,000, which will be 24.5% till date. Remember, this is not for the year, this is till date, 24.5%. 13,10,000 into 13,10,000 divided by 20 lakhs comes to 65.5%. 18,80,000 upon 20 lakhs comes to 94%, and last May this is 100%. So your revenue ideally should be recognized on a till date basis. So your revenue till date should be recognized based on this. However, your revenue should be based on what? So when we are looking at question 7, we can say that the revenue for the period, year 1 up to year 3 would be based on 22 lakhs, which is your fixed transaction price, plus the most likely variable consideration, which is not constrained, which is 2,20,000, and hence 24,20,000 will be your transaction price. But when you look at year 4 to year 5, the revenue would be still 22 lakhs. However, we now believe that we will achieve the 25, the less than 700 kg criteria, in which case you will get 5,50,000 and hence 27,50,000 will be your revised transaction price. Remember, this transaction price revises in year 4 and hence it will not have a retrospective effect in year 1, 2 and 3. So if I were to recognize my revenue in year 1, 2, 3, 4 and 5, I will say that the total revenue over here that I should take into consideration is 24,20,000 into the stage of completion. A longer method would be into the stage of completion, that is 6%. This is revenue, remember, till date. However, if I want to find the revenue for the year, you can say revenue earlier recorded. You will reduce this and hence that will give you the revenue for the current year. This will give you the revenue for the current year. So if I do 2420 into 6%, I will get 1,45,200. There is no further revenue recognized earlier, and hence 1,45,200 will be shown as my revenue of the current year. To compare that with the cost of the current year, I will have 1,20,000 of cost, and hence your profit, if I go to see, my profit will be 25,200. If I want to find the operating margin, that is 25,200 upon 145,200, and hence this will be around 17.36%. Next, when I do the workings, I'm still at 24,20,000, and by the longer method, you can do the simplification method over here since it is given in the question, but let's say if it was not given, then I would have done the till date working, in which case I would have done 24,20,000 into 24.5%, which is 5,92,900 minus earlier recorded of 145,200. So this is 145,200, and hence you have 592,900 minus 145,200, which comes to 4,47,700 against the cost incurred in the second year of, I think, 3,70,000, and hence the profit to be recognized would be 77,700 on the base of 447,700, which will come to around 17.36% again. Revenue is recognized in the same tandem. Then you again go to 24,20,000 into 65.5%. So that's 2420 into 65.5% comes to around 15,85,100 less earlier recorded. I think total of 592,900 has been recorded, 447 plus 145,200, and hence if I subtract 592,900, I do get 9,92,200, against which the cost in this year, I guess, was around 8,20,000. So I will have an 8,20,000 cost, which I subtract to get a profit of 1,72,200 on the base of 992,200. I'm again at 17.36%. Now comes the fourth year, and in the fourth year, my revenue will be 27,50,000 because my assessment of variable consideration changes and my stage of completion is 94%. So I'll say that in the first 3 years, I'll not retrospectively restate anything. However, 27,50,000 ka 94%, that is 25,85,000 should have been recorded till the fourth year, out of which 15,85,100 was recorded earlier, and hence this will be 9,99,900 to be recorded against a cost that you have incurred of, I think, 5,70,000 in this year, and hence there will be a huge profit margin. So if I look at this minus 5,70,000, my profit will be 429,900. It is largely because of a cumulative catch-up adjustment that is happening, where the variable consideration earlier was based on 2,20,000. Now it is 5,50,000, but for the past 3 years you have already recorded based on 2,20,000, and hence there is a significant adjustment due to that. So that is 429,900 divided by, let us say, you can take 9,99,900. I mean, this is an abnormal profit. You can always take an evened out profit as well. So this is 42.99% or 43%. And in the last year, this is 27,50,000 into 100%, which will come to 27,50,000 less what is earlier recorded, which is 25,85,000. And hence 2750 minus 2585 will come to 1,65,000 less earlier recorded of, I think, 1,20,000, and hence I am having 45,000 of profit. 45,000 on the base of 165 should come to around 27.27% operating profit margin. Let me just verify the answers once. You get 145,200, 447, 992. The important one is 9,99,900, which you have done using a slightly different method, but getting the same answer. And last it is 1,65,000. Costs are as given in the question, and you get profits. You get 17.36% in the first 3 years, then 42.99% and 27.27%. This is exactly the same answer that we get. The institute has also mentioned that in practice, under the cost to cost method, total revenue for each period is determined by multiplying the total transaction price, fixed and variable, by the ratio of cumulative cost incurred to the estimated cost less revenue recognized till date. So this is the method that we have alternatively done. This is what the institute has mentioned. In this question, for simplification, they have allowed you to directly take the cost incurred, let us say of 8,20,000, upon the total estimated cost, and based on that directly recognize the revenue for the third year for a simplification purpose because of this paragraph given. But we have done the slightly longer version, which covers, let us say, a holistic perspective. So that takes care of December 21 question. And last, you have the May 22 questions. There are two questions that have come over here. One is a case-based question and one is a numerical one. So let us try these. These are relatively easier, or I would say some of the easiest questions that have come in the Indus 115 history. So Anandam enters into a contract with a customer on 1st April 19 for the sale of a machine and spare parts. Okay, the manufacturing lead time for the machine and spare part is 3 years, so it is taking 3 years. Now we will have to see whether the revenue has to be recorded for these performance obligations over 3 years or at a point of time. On completion of manufacturing, Anandam demonstrates that the machine and spare parts meet the agreed upon specifications in the contract. So I have to demonstrate that the promises to transfer the machine and the spare parts are distinct. So there are two distinct promises. They are not highly interrelated, not a part of segment integration, not customization modification. Hence they are distinct as given in the question, and result in two performance obligations, each of which will be satisfied at a point of time. Question very clearly tells you that machine is a separate performance obligation which is satisfied at a point of time. Spare parts are also a separate performance obligation which is also satisfied at a point of time. The question is which point of time. As on 31st March 22, the contract, remember, was entered on 1st April 19. You are now 3 years later, 31st March 22. The customer pays for the machine and the spare parts, but only takes the physical possession of the machine, which means on 31st March 22, for sure, machine, since the physical possession is taken by the customer, the performance obligation is discharged. And as a revenue, whatever is the revenue attributable to the machine will be recorded on 31st March 22, that is the point of time. Although the customer inspects and accepts the spare parts the customer requests that the spare parts be stored at Anandam's warehouse because of its close proximity to the customer's factory. Acha, which means they are not taking physical delivery, but then is the performance obligation discharged at 31st March 22? It seems to be, because the customer has accepted the products, but let us see. The customer has legal title, perfect. So it has legal title. So even though it does not have possession, it has the ownership of the spare parts, and the parts can be identified as belonging to the customer. Okay, Anandam stores the parts in a separate section of the warehouse, and the parts are ready for immediate shipment at the customer's request. Anandam expects to hold the spare parts for 1 to 3 years and does not have the authority to use the parts or direct them to another customer, which means even though Anandam, who is the seller, has the physical possession of the spare parts, they cannot divert it to someone else, and hence the control is transferred to the customer, because the customer can prevent Anandam from doing what they want with the assets, and hence the point of time at which you should recognize revenue for the spare parts is also 31st March 22, even though the physical possession may be transferred later over 1 to 3 years. Determine how the revenue will be recognized by Anandam for the different performance obligations as per Indus 115. So for the two apparent performance obligations, the revenue will be recognized on 31st March 22 only. However, there seems to be a third performance obligation which is for custodian / storage. Now, this is not explicitly mentioned, but over here, since Anandam is responsible for storing these parts over a 2 to 3 year time frame or 1 to 3 years time frame, it is on a standalone basis. It may expect something, and if it does expect something, the revenue recognition for the same will be done over a period of time which is from 1st April, let us say 22, up to 31st March, let us say, of 23, 24, 25 as the case may be, till the time the warehousing services or custodian services are provided. So there are three obligations: sale of machinery, sale of spare parts, and custodial services. Such services will be given for 1 to 3 years from 31st March 22, and the revenue should be recognized for them depending on the allocation, depending on the standalone selling prices. And then we go to the last question from May 22. Card Limited is engaged in the manufacturing business of car locks and nut bolts. So for car locks, typically a contract is entered for the sale of car locks, and consideration is received in the event of delivery of the goods to the customer's place. Okay, perfect. The cost of each car lock is 1500 and the selling price is 1800. So on sale, I will get 1800. The terms of the contract entitles the customer to return any unused car locks within 30 days and receive a full refund. Okay. So you can return the unused car locks within 30 days and receive a full refund. So this is sale subject to return. The company estimates the cost of recovering the car logs will be immaterial and expects that the returned car logs can be resold at a profit. Okay, so the returned car logs, remember, are like inventory, and inventory is measured at cost or NRV, whichever is lower. The cost of the car logs was 1500. Even after selling and taking the return, we still expect these car logs to be sold at a profit, and hence the NRV is higher. The returned car logs should ideally be measured at cost of 1500. The company has sold a total of 20,000 car logs during the month ended 31st March 22. So the last month, and there's a 30-day return window, and hence the returns will happen in the month of April. We don't know kitne returns hoge. From the past experience, card expects that 4% of the car logs will be returned in the financial year 22-23. Acha, what do we have to do? If you go to the next page, it says in sub-point 1, analyze the revenue recognition contracts with customers for sale of car logs as per Ind AS 115, determine the amount of revenue, refund liability and asset to be recognized by card for the said transaction of car logs. A very easy question, I would say. So if I look at question number 9, for the car logs, at what level should my revenue be recognized? Well, revenue should be recognized to the extent of consideration that an entity expects to receive. So over here, out of the 20,000 units, 4% are expected to be returned, and hence 96% are expected to be sold. And hence 20,000 into 96% will come to 19,200 units. For 19,200 units, you are expecting consideration to be received, and there is a significant possibility that the reversal will not have to be done. And hence, you will multiply this by, let us say, into rupees 1800, which is the revenue, and hence 19,200 into 1800 will come to, let us say, rupees 3 crore 45 lakhs 60,000. So 3 crore 45 lakhs 60,000 is the revenue to be recognized. However, why will there be a refund liability? Well, because the customer would have paid you for the entire 20,000 logs, which means even the 20,000 into 4%, that is 800 logs that you are expecting the customers to return. For these 800 logs as well, the customer would have paid you 1800 rupees, and hence you will have to pay the customer 1800 back once they actually refund, and hence there will be a refund liability of 14,40,000. But you should remember that when the customer, you have an obligation to return, but at the same time you have a right to recover your assets or goods back from the customer, and hence to the extent of that you will have to record an asset, a recovery asset, or you can also call this as your inventory or goods lying with the customer. How many of your goods are lying with the customer? 800. And what is the valuation of these goods? Well, the lower of cost, that is 1500, or NRV, which is higher than 1500, and hence you will measure them at 1500. So over here, 800 into 1500 will be 12 lakhs is the value at which the asset for recovery should be recorded. Just for a general reference, if you had to pass a journal entry, not required in this case, but if you had to pass, the entry would be bank account debit, let us say 3 crore, 3.45 crores, to refund liability, let us say 14.4 lakhs, sorry, my bad. If I had to pass an entry, my bank would be debited by 20,000 into the entire 20,000 into the entire 1800, whatever that amount comes, to sales would be at 3.456 crores, and to, let us say, refund liability would be at 14.4 lakhs. Acha, and then a separate recovery asset account debit to, let us say, you will credit your trading or profit and loss account. It will impact your cost of goods sold. It is like closing stock, but not in hand, but with the customer. Okay, so this is about the first part, that is car logs. Second, so let me just verify this. Well, you have 3.456 crores of revenue, refund liability of 14.4 and an asset of 12 lakhs. The last part now, nut bolts. On 1st April 21, card enters into a 1-year contract with the customer to deliver nut bolts. Okay. The contract stipulates that the price per piece will be adjusted retrospectively once the customer reaches a certain sales value as defined below. So you have been given various sales values, and the volume is determined based on the sales during the year. There are no minimum purchase requirements. Card estimates the total sales value for the year will be 90,000 based on experience with similar contracts and forecasted sales to the customer. Now this is a question which is similar to the November 20 question, November 20 or 21 question, where you had three possibilities: 9,000, 28,000, 36,000. Here you don't have those three possibilities. Here you have a single possibility, and hence the only way in which you can solve is the most likely value. So over here you have 90,000, which is based on experience in similar contracts, and hence 90,000 is falling within the bucket of 190, and hence your transaction price, the most likely sales value is 90,000, and the most likely transaction price at that sales value is, let us say, 190. Acha. Card sells 24,000 pieces to the customer during the first quarter of the year 21 for a contract price of 200 each. Remember, the discounts are volume based, which means till the time you don't reach 50,000, you will have to pay 200 per piece, but the moment you reach 50,000, the seller will give you a credit note for the excess payment that you have already made, and you can adjust that. Going forward, your prices will be 190. If at all you cross 1 lakh, then the seller will give you a credit note for the excess amount that you have paid, that is, you have paid 190, and your sales will be recorded going forward at 180. Now in this case, if you go to see, for the second part, you will have nut bolts, and your most likely transaction price is actually 190. However, you have sold in quarter 1, you have sold 24,000 units, which means you have not yet crossed the 50,000 barrier, and hence you will have to pay for the 24,000, or the customer will have to pay 24,000 into 200, which will come to, I think, 48 lakhs. So your bank will be debited by 48 lakhs. However, the revenue cannot be credited by 48 lakhs because you believe that the customer, based on your past experience, will cross 50,000 and go up to 90,000, and hence your revenue will be recorded based on 190. So that is 24,000 into 190 will come to 45 lakh, 60,000. So what about the remaining? Well, we are saying 10 rupees we have recovered in advance, and hence we can show this as advance, deferred revenue, unearned revenue, or also a contract liability to the extent of 24,000 into the additional 10. 10 is nothing but 200 minus 190, that is 240, and hence your entry will kind of balance. What is the question asking you in subpoint B? It is asking you determine the transaction price, which is, I think, 190, the revenue, which is, I think, 45.6 lakhs, and the liability, which I think is 2.4 lakhs, if any, of nut bolts as per Ind AS 115 for the first quarter of the year 21-22. So we'll just verify this. The revenue is 45 lakh 60 and the liability is 2 lakh 40, and your transaction price will be based on 190 rupees. So that's it. I hope this session has been helpful in addressing the questions that have come in your past exams. Not all of them have entered into your institute study material, but 115 has been that area where the exam questions generally have baffled students, and they are at various places. Solutions are done in a slightly different way. So I hope this entire session, where we have tried to keep all the questions at one place, try to solve them in the best way possible, in the best time efficient manner. I hope this video has been helpful. If yes, please do like and share. Please do comment and let us know if you want to cover anything else, or anything that you think which can help your preparation and where we can help you. I'll be really happy to help you, and that should be it for today. I'll see you soon with some other video. Till then, bye bye, take care and keep studying. Good luck.